Most traders lose money on fair value gap, not because the model doesn't work, but because they traded at the wrong time. And most often, the strongest movement begins not from the fair value gap itself, but after its inversion. It's the inversion fair value gap that shows the moment when the market changes its balance and uses the positions of participants as fuel for the next impulse. The inversion fair value gap is one of the simplest and at the same time most effective models in the smart money concept. But seeing it on a chart is not enough. This model has clear conditions under which it really becomes strong. In this video, I'll analyze how to trade it correctly, what factors strengthen the model, and why in certain situations it gives a clear continuation of the movement. If this is your first time hearing about the inversion fair value gap, it's actually easier than it seems. A regular fair value gap is a gap in fair value that appears during a strong impulse and reflects an imbalance between buyers and sellers. Basically, the gap between the first and third candles is this imbalance. That's what we call the fair value gap. An inversion fair value gap forms when the price stops respecting this imbalance. Instead of the expected reaction to the fair value gap, the market breaks through it and consolidates on the other side. It is this disrespect for the initial imbalance that is called inversion. Hence the name, Inversion Fair Value Gap. Now that you understand what an inversion fair value gap is, let's move on to the important part, the conditions under which it really makes sense to use this model. The first and mandatory condition is the withdrawal of liquidity. Without this, the inversion becomes significantly weaker. And there is a simple explanation for this. We see an aggressive long movement on the chart within which a bullish fair value gap is forming. Visually, everything looks like a continuation of growth. But if this movement was aimed at removing buy-side liquidity, then its main goal has already been achieved. The price reaches liquidity, takes it out, and begins to return to the fair value gap. At this point, the majority continues to look for buys because they see a bullish fair value gap and upward momentum. But if you understand that the final target in the form of buy-side liquidity has already been achieved, the logic changes. After liquidity is taken out, the market reacts, and it is this reaction that begins to form the inversion fair value gap. In other words, the zone that was supposed to continue moving upward begins to work in the opposite direction. This is the essence of the model. Aggressive delivery of the price to the target, followed by the withdrawal of liquidity, after which the market reacts strongly in the opposite direction. It is this reaction that forms the inversion fair value gap, which we already used to trade in the direction of a new impulse. Now, let's move on to the most interesting part, how to use this model in trading. The inversion fair value gap doesn't have a fixed time frame. It can be found on both higher and lower time frames, but it is important to understand the difference. The higher the time frame, the more serious the consequences of the inversion. If the model is formed on an hourly or 4-hour chart, it's usually based on more significant liquidity and a larger imbalance. As a result, the movement after the inversion is often deeper and more structured. On lower time frames, everything happens faster. There are more inversions, but not all of them really change anything in the overall structure. If you start reacting to every such pattern within a minute or 3, it's easy to start entering without a full context. Therefore, I use the lower time frame as a tool for accurate entry, not as a place where I make decisions about direction. Since I trade intraday myself, I'll first show you how to use this pattern within the day. The first thing we always wait for is liquidity withdrawal. In this case, the previous day's PDH was withdrawn during the Asian session. But the key point is not the fact of withdrawal itself, but how the price behaves next. After liquidity withdrawal, we don't get a strong short reaction. On the contrary, an aggressive upward delivery begins with the formation of a bullish fair value gap. I mark this zone because the first rule has already been fulfilled. An important pool of liquidity has been taken out. And that is why I'm not interested in working from this zone in long. I'm waiting for the market to show that the movement is complete and the inversion will begin. As soon as the price breaks through and consolidates below the marked fair value gap, an inversion fair value gap is formed. This confirms that the buy-side liquidity target has indeed been realized, and the priority has shifted towards sell side. After the pattern is formed, I wait for the zone to be tested and only then consider entering the trade. The price returns exactly to the inversion fair value gap area, gives a reaction, and it is from there that a short position is opened. The next day, the movement is realized, and the position is closed at the take profit. Let's look at another example, this time on gold and during the London trading session. Here again, an aggressive long movement is formed with the formation of a fair value gap, which leads to the removal of buy-side liquidity. I mark this zone and then wait for the appearance of an inversion fair value gap. because after the realization of liquidity, the priority shifts towards short trades. In this case, two inversion fair value gaps are formed at once. In such a situation, there are two options. Either wait for the upper inversion fair value gap to be tested as a deeper and safer entry point, or work from the lower one, understanding that the price could potentially test the upper model. If entering from the lower one, the stop loss should be placed above the upper zone, as shown in my chart. Here, the risk-reward ratio is quite attractive, so I didn't wait for the upper model to be tested and opened a short position from the current inversion fair value gap, with the aim of removing liquidity from the Asian session. The trade closed at the take-profit level, and after that, the price rose to the upper inversion fair value gap and gave another short reaction from it, which further confirms the strength of the entire model. Now let's talk about how to use the inversion fair value gap for swing trading. The logic remains the same. The first thing we want to see on the chart is an aggressive movement with the formation of a fair value gap, which led to the removal of liquidity. Without this, the inversion makes no sense. After liquidity is taken out, it's important to understand that this pool was indeed significant. This is usually confirmed by an aggressive price reaction in the opposite direction. It is this reaction that forms the inversion fair value gap model we are already familiar with. When the model is formed, I wait for a pullback to the marked inversion area. In this case, it's logical to expect a return to this zone because it's the first short fair value gap formed after the reversal. At the same time, there is another fair value gap above, so I place a stop loss behind it, taking into account the possibility of a deeper test. In such a situation, you can place a limit order and calmly wait for a return to the zone. Note how additional models are formed further on, which give perfect tests of the same area and further continuation of the short movement. This allows you not only to hold the first position, but also to open another short trade, moving the first trade to break even if you want. Now, for those who still find it difficult to understand this model or feel that they don't always have time to build the structure and context on their own, you can use the OWL indicator. This is not a smart money tool, but a full-fledged trading system that works strictly according to the trend, helps to determine the entry point, and gives a clear trading signal. It doesn't replace understanding of the market, but it can simplify the decision-making process and remove some of the subjectivity. By the way, I have resumed open statistics on this indicator, and video reports with trading results will be released in the near future, so you can see for yourself how the system works in practice. As always, I'll leave the link in the description. I'll say right away that inversion fair value gap also works well in the cryptocurrency market. The mechanics of the model remain the same: liquidity withdrawal, reaction, and imbalance inversion. But if you don't have enough experience yet, I wouldn't recommend switching to lower timeframes right away. It's better to start with higher periods, where models appear less frequently, but their performance is often clearer and easier to understand in terms of structure. I use the Evedex exchange to trade cryptocurrency. It's a decentralized platform for trading derivatives without KYC, with fast execution and low commissions, which is especially important when working with intraday models and position management. As always, I'll leave a link to the exchange in the description below the video. As you can see, the inversion fair value gap is a fairly simple and straightforward model if you use it correctly. It doesn't require complex tools or dozens of confirmations. It all comes down to understanding liquidity, price reactions, and when the market shifts its balance. When you start looking at inversion not as a random breakout, but as a consequence of liquidity removal and change of control, the model becomes logical. And then you stop guessing the direction and start working from the causes of the movement, not its consequences. The main thing is not to look for it everywhere and not to trade in isolation. The context from the higher time frame always remains the basis, and the inversion fair value gap is a tool for the precise implementation of your idea. If you found this video useful, please support it with a like and a subscription. In the next reviews, we'll get even deeper into the structure of the market and the models that really give you an advantage when approached correctly.